This is Kim Arthur and James Maxwell from San Francisco to give you the macro outlook for the third quarter of 2025. So, how you doing today, James?
Doing well, Kim. Happy Wednesday here, and I think we're waiting until the dust has settled a little bit to try to get an outlook out there. Obviously, it's harder when things are in motion.
I love it. I love it. Quick update here again. First of all, I want to thank all the advisors for the partnership that you have with Maine. We cannot do it without you. Just a quick snapshot on this. This is at the end of June, 4.2 billion. We're probably closer to almost 4.5 billion right now. Market and flows, which again, big shout out to all the advisors for your help. Your investment team, again, is 5 deep on the bench for the investment committee. 3 of the 5 have been here since the inception of the firm. So that's good to know that the results that you see for the different strategies have been put together by the 3 original. And then we've built it out, obviously, with Alex Varner and Daryl Ryan, and obviously lots of help from James and Alex Dippery in the research. So just quickly, obviously, it's costs, trust, price improve, and time in the market. Those are our key linchpins that we always like to look at. All right, James, what do you see here?
Yeah.
We had a interesting thing in the quarter, which feels like it was a year ago, but it was only 6 weeks ago. What's kind of your snapshot from this?
Yeah, the biggest thing in this Q2 and even up to today, I think has been the rebound off of the low set during the whole kind of Trump tariff debacle as defined, on Liberation Day, April 2nd, and then coming back off those when those tariffs were kind of pushed off for that 90-day delay, and since having those trade deals and a number of kind of more clarity on the tariff side of things. As a result, you've seen a rebound in a lot of the things that were hurt during Q1 and during April. One thing that I'll point out on this chart is the international performance.
Exactly.
Obviously, it's continued to do well year to date, kind of withstanding those tariffs a bit more than U.S. domestic equities, which you kind of see at the bottom there, that U.S. small cap continuing to kind of struggle, even though it was up 8.5% in Q2, only up, low single digits year to date. So yeah, I think that's the trend, that one of the trends that we're watching.
Yeah. The other thing that jumps out at me is everybody's been panicked about inflation. Not everybody, but obviously the Fed has panicked about inflation. The market's been worried about inflation. Commodities were down 3%. And you get a doubling down on it again from this one that I'll let you address here. But energy was down 9%. You usually, in order to have inflation, you've got to have the commodity should be rising. So this is obviously showing the opposite.
Yeah.
What else do you see from the individual sectors?
On the commodities piece and inflation, I think the biggest thing I see is that there's the demand kind of push down that you get from tariffs. People, have their money to spend, and if they're spending slightly higher on one side, like the goods side, they'll spend less on the services side. So it naturally kind of shifts their spending overall rather than being a purely inflationary kind of impact.
Yeah. Yeah. And we're going to hit tariffs a little bit later, but I would say I'm a firm believer a tariff is a tax. Taxes are not inflationary. They are demand destructing, but we'll hit this later again. The amount in aggregate that these tariffs represent of a $30 trillion economy is teeny, i.e., there's not demand destruction. So obviously IT was leading the pack here. Consumer discretion came a little out of the ashes there. Okay, this one is always fun to look at here. So obviously April 8th, at the bottom of that green line, for those of you that can't see this as the trend when you have a bear market going on, a trend when non-bear market, and then the average lives in between that. And we felt like a bear market as we were trying to discount a recession on April 8th. What's happened since then, James?
Yeah, as you can see, and this is something we were talking about when we were down at the bottom with a lot of clients, was if you look at history, if you look at these corrections, they tend to bounce pretty hard. And in this case, it bounced even harder than we expected. I think there's a lot to kind of unpack on why that was the case. One of the reasons that we'll kind of get into is this self-inflicted part of it, where it wasn't the same as like an '08 or a dot-com where it was these external forces that, hurt the overall economy. This was very much a kind of sell-off due to fear, due to that self-infliction. Reminds me a lot in a lot of ways of COVID,
Yeah.
that sell-off and how sharp that V recovery was. And obviously different environment, different reasons, but just purely on kind of the market action where you're getting that sharp drawdown due to things like shutdowns,
Yeah.
in this case, due to things like tariffs. And then as soon as it kind of eases off, you take off on the upside. I think that caught a lot of people off guard. I mean, you saw the number of recession calls that were starting to come out during that first week of April.
They were crazy, and trust us, we were not immune from those emotional roller coaster. We came into it thinking this year that we were going to have a growth bias. And again, part of our job here as the manager is trying to decipher the signal from the noise. And as we've said repeatedly about this, Trump's noise aura is ginormous, but his signal is very, very, very precise. And it's all about lower taxes, lower regulations, and lower energy costs. And so we did have some sleepless nights, but we kept trying to remind ourselves, signal. So this is very interesting, James. Again, it shows you what happens after you have a post-correction recovery.
Yeah.
Remember, we were down almost 20% from peak to trough. What does this tell you that the forward period looks like after that V bottom?
Yeah, so basically what this chart is trying to address is kind of the natural tendency to say, okay, we just had this correction. We're back at pre kind of correction highs. Now it must be a cooling off period, right? And if you actually look at the data and look at in this case, 34 past corrections, that's not really the case. What tends to actually happen is forward performance of the S&P 500 is actually better once you've recovered from that correction that just happened. And I think kind of if you think about why that might be the case, something that comes to mind, at least for me, is there's a lot of uncertainty. The reason why there was that correction, it was most likely an uncertainty driven sell-off, which is what happened here. After the market is recovered, you can kind of assume that a lot of that uncertainty has gone away, that the fog is cleared.
Yep.
Things are kind of, okay, we've passed this big hurdle. And from there, it's kind of, there's not a lot of kind of headwinds for the market to address to kind of just continue to climb that wall of worry, which we mentioned here. I think that's the broader takeaway. Obviously, every situation's a little different, but if you look at the data, that's what it says.
And just to put some numbers around it for people, the pre-high was 6,100 on the S&P. So we got back to that high basically at the end of June, just to make it simple. So this tells you that 12 months from now, the end of June of 2026, the market would be roughly 7,000. What's interesting is our internal price target here is 6,900. So it's funny how the two of them kind of jibe together. So good job, research. This is a really busy slide, but there's a lot to pull out of it here. It's looking at peak to troughs at any given year, which you put a line across there. The median drawdown's 10.6%, call it 11. Again, we had a peak to trough of 20%. But what I like on this one is it shows you each of the years of what the full year on the S&P was. And I like to kind of like tease things out of it. And what I look at this is anytime that we've had a down 20%, what happened the following year? And the following year on average was up 15, which kind of again goes back to your 15% forward 12 month. But there were two exceptions on that. And that was 1975 and 2002. And those were both recessionary years. So if there is a recession, it's not a good outcome. You know, you're going to have like a down 30% year. But the recession is not in our playbook, and we'll get to that in a little bit here, just about some of the other constructs that are going on. But again, this is a great piece. Research put this together, a lot to unpack. For any of you data junkies out there, slide 9, you can really spend some fun with. All right. This is the economic policy uncertainty that spiked to an all-time high. And I've looked at a up to date one. I looked at it through yesterday. It's like 250 now.
Yeah.
So maybe talk to us a little bit
It's
about
definitely
this.
it's definitely fallen off. I think generally it's still, high relative to history, but relative to its peak in July or sorry, in April and March, it's definitely come down. Just to kind of talk about this indicator a bit, basically what it's doing is it's looking at historical news articles. So it can go back a
Mhm.
very long sweep of time, I think over, 50 years and say, okay, how many news articles proportionally are discussing or mentioning kind of something about the economy, something about uncertainty,
Ah.
something about legislation, Congress, White House, to get at basically very broadly how many people are talking about uncertainty given kind of what's going
Interesting.
on in the government, what's going on in the economy.
Yep.
So it's an interesting way to kind of measure that level of uncertainty. Obviously, it's not a perfect indicator. It kind of gets skewed if there are just naturally more articles,
Sure.
but it is interesting to look at, and you can see in April, it went to an all-time high even outside of COVID. And one thing that we've looked at is those spikes historically, whether it was COVID or I think right after 9/11 was another one, or even just over periods of time where there's trade and economic policy uncertainty. Those are good times to be buying the
Yeah.
market. And this is something that we mentioned, in our last quarter, and it's obviously proven to be true so far that you want to be buying that uncertainty. You want to be, when there's blood in the streets, it's the best time to buy.
Yeah.
Is kind of the general consensus, and this is another example of that.
Well, and this goes back to what you'd said earlier. This was sort of an artificial construct in April that people thought that the Trump administration was going to shut down all commerce,
Hmm.
which is kind of odd when you have a pro-business leader in the White House.
Hmm.
But again, perception is reality, and these two, the COVID spike and this tariff spike, look identical. And the real time update now brings us back. It's still elevated. It's
Hmm.
above one standard deviation. You're kind of back to where you were with the European Union Greek drachma
Right.
crisis that
Yep.
we had in 2012. So, meaning that there's still more that this can kind of calm down and the markets can go higher. So, speaking of what caused all this Trump tariff tantrum, this is a picture on the tariffs that, we had kind of penciled in between 10 and 20 was kind of where things were looking like. It looks like we're keying in towards a 15% rate. There's approximately 3.5 trillion of imported goods. The run rate currently right now is closer to 10%. The administration is clocking about $30 billion of tariff revenues a month. And if that gets up to 15%, it would be about 500 billion. The good news on that is that would go towards the deficit that is out there. And last year, that deficit was about 6.3%, low sixes, and people were fearful that it was going to go to 7. There's a good chance with the tariff revenue now that this could be more like a high 5 number.
Hmm.
And again, everything in DC is about on the margin. I'd mentioned earlier about the order of magnitude. If you have 500 billion in revenue of tariff costs, and currently that's split like a third, a third, a third. It's a third that the manufacturer is absorbing from overseas. It's a third that the importer is absorbing and a third that the consumer is getting. So if you get down to the consumer's portion, which is 150 billion, let's say, and incrementally it's less than that because there were tariffs last year. On a $30 trillion economy, that's why, again, I say it's very, very insignificant. That's why the market's at all-time highs. Okay, speaking of that, talk to me here. This is your GDP that we know for the first half of the year averaged about 1.25%. And this is a little dated because we did this a few weeks ago,
Hmm.
but it shows the third quarter that we are currently in. The guesstimate was less than 1% for
Hmm.
GDP. Can you update us on this?
Yeah. So one thing to kind of talk about here, because of the tariffs, a lot of the result of those is a lot of trade kind of distortions,
Yeah.
especially on the timing of imports. So a huge contributor for the Q1 drop in GDP was that bring forward of tariffs that you have to then offset, or that counts against the overall growth number. Q2, you've kind of seen the reversal there. That actually that number, the first estimate is printed at 3% growth, and you've kind of seen that across Q3, Q4. actually kind of moving up here off of those lower numbers, that lower base.
Interesting. And we'll talk in a little bit here, just this bull market, which is about to hit the end of its third year in October. Typically at this stage of the cycle, you would have accelerating M2, you would have much higher small business confidence and much higher consumer confidence. Those are just starting to turn, which are all potential tailwinds for the market. Our favorite topic here, inflation, which we hit a little bit earlier here, that we think that these tariffs are not inflationary. If you look at this core PCE, it's 2.7%. Typically, if the Fed believed that that was where inflation was, the Fed funds rate should be at about the same level.
Yep.
And the Fed funds rate is at 4.37%. That's why the markets right now are, they've got 2 rate cuts for the back half of this year, basically one in September and one in December. And then they have like 100 basis points next year. So that would be 150 basis points. You'd still be above. You'd still have real rates that are tight. So that's an interesting thing. Obviously, we'll have a new Fed chairman next year. Trump has 8 candidates that he's looking at. But you can make an argument that we are very restrictive right now. Tariff impacts. We kind of hit that a little bit here. So let's go over that. Labor market. I know a little bit of this is delayed because we had major revisions, but maybe you can hit a little bit and remind people that 80,000 per month is kind of the treading water level. What else do you see?
Yeah, one of the things, the labor markets are in a really interesting spot right now. Obviously, in 2024, you had huge immigration effects that distorted a lot of the numbers. And those have basically dropped to zero immigration or net immigration. So part of the kind of looking through and all this noise is counting that out, which brings down your break-even employment rate to around that kind of 80,000 number, basically meaning that you only need to add 80,000 jobs, around 80,000 jobs a month, in order to kind of maintain that employment level. There's kind of been a lot of distortions around that. You've seen the unemployment rate as a result stay steady at that low 4% number, as opposed to, if I think one of the things that we looked at is if that labor force amount was growing at the same rate it was in 2024, that unemployment rate would have looked a little bit higher. So it just tells you that basically you need to look at a lot of different indicators. It's hard to rely on just one because there's so many moving pieces, especially for something like the unemployment rate. You know, the numerator and the denominator are moving around. You need to kind of look at both and see what's driving the actual movement or their lack thereof. But I think one of the things that the Fed is watching, obviously their dual mandate is inflation and employment. Employment seems to be weakening on the margins, but there's not any sort of massive red flags out there, at least that we see.
Yeah. And I know, there's all kinds of controversy around. We're going to have a new Bureau of Labor Statistics person. And there is, listen, we're not going to get political here, but I will say those revisions were so far out of the realm. You hadn't seen those revisions outside of recessionary periods in almost 70 years, 70 years. The data collection process is antiquated and needs to be brought into the 21st century. So whatever they're going to do, they've got to bring it up. And, I saw a figure that a former BLS head said, well, we only needed $15 million to do a skunk work for 2 years, so $7 million a year. It's like, well, why didn't you go ask for that? If that's all you needed was $7 million. But anyway, there is, like you said, the supply has flattened out, and we've got, productivity that's trying to pick up. We've got AI that's going to come in. So there's a lot of moving pieces here. Okay, this is Fed funds. We've already hit that one, so we can kind of skip on to the next one. This is the dollar index, and basically the Dixie we know has dropped about 10% in the first half of the year. That was one of the largest drops going back for a long period. It's stabilizing here at this level here. We're going to have a lot of movements. We can go into a whole segment, a whole podcast about Moran that's been,
Mhm.
filling the temporary position that's just open until January. It's a small position. But he is the proponent of this Mar-a-Lago Accord, which would be a whole currency revaluation. But again, that's a whole nother discussion. Okay, international equities. Why don't you, this looks like we're finally seeing a turn. It's outperforming the S&P for the year to date, and then,
Mhm.
for the trailing 12 months, I believe.
Yeah.
What do you see out of this?
So it was the first 2 quarters, you had this massive outperformance of international. A lot of that was led by on the way down, international went down less, and then also in the recovery kind of stayed in line with the S&P. I think, you know, if anything, the big takeaway from this first, 8 months of the year is it's important to be diversified
Yeah.
in your equities, where I think for the past 15 years, and this is something we've hit on before, you've been rewarded by being only in the US.
Yep.
And I think this outperformance, I mean, even just from quarter to quarter, showing it reduces volatility. It helps when things are hurting domestically. Internationally, it might not be the same case. I think a lot of people, they're not only below benchmark
Yep.
weight, they're out of the asset
Out
class
of
of
it.
international entirely. So there's clearly a lot of kind of room to gain in that asset class. I know, speaking with a lot of other investors, it's becoming increasingly looked at. Not a
Yep.
lot of action, but a lot of eyes on it.
Yeah.
Obviously, eyes kind of prelude the actual action, but something to keep an eye on.
Yeah, I like to say the pain point for the advisors that are underweight this asset class. And again, to reiterate what you said, they've been dead right for the prior
Hmm.
decade plus. But that pain point is going to become very, very real at the end of this year. I think you will see if this asset class holds up here, you'll see an allocation into it. I like to remind people that your comp that you want to look at, it's not the S&P 500 multiple or mix because we are a third tech. And most of these international markets, they look more like US large cap value.
Mm.
US large cap value trades at about 17 and a half times versus 14 times for international. And when you get these outperformance periods that we think we're just starting, we're only a year into what could be a 5-year period here, they typically trade at parity. So that would mean that the 14 multiple goes to 17 and a half times. That's 20% with no change in earnings. You would then start to get the earnings going on. So there is a case that can definitely be made for it. Consumer confidence, I'll just hit quickly on this. This is what I had mentioned earlier, that typically at this stage of the cycle, 3 years into a bull market, this consumer confidence is below 100. When it gets to the top level, it's up at about 140. Okay. These are long cycles
Mhm.
that they go. So this is a feature. Usually by this point, you should be pick a number there, but well north of 100. We're at below 100 with the potential to go to 140. That gives you some run room. And we're also starting to see, which is not on this slide, but small business optimism has just started to turn. It just went above its historic average, which is 98. It's at 100. Again, a big part of that is clarity now on the tariffs, or at least enough clarity where they can make a business decision. The one big beautiful bill that has lower permanent taxes, has CapEx expensing, immediate expensing, and it has lower regulation. So all of these are pro business, which is why you mentioned GDP looks more like 2.5%. And next year, who knows? You could have a 2 to 3 handle, 2% to 3% for GDP. All right, earnings estimates. We know the first quarter earnings, they were supposed to be up 6, they came in up 12. The second quarter that we're basically done with now, we're supposed to be up 4, they're going to come up 11. So again, we've got these low double digits. What's the back half of the year look like?
Yeah, I mean, I think just on this
Yep.
kind of quarter first, one of the reasons why the market's done so well has been the better than expected earnings from a lot of these large cap leaders.
Yep.
So that should, is expected to continue. You see that next 12-month number on there at a roughly 12%. That double digits earnings growth just really helps the overall index grow over time. Obviously, a large part of long-term performance is that earnings growth of, you get the multiple, but the long-term build out of the index, the kind of growth over time, comes from earnings.
Yeah.
So that's something that is super, super important. And why we watch earnings is because ultimately how the index performs is how earnings perform.
Exactly. We like to point out, like, bear markets, the bottom, it depends on what the valuation. The 22 bear market bottomed at 15 times because earnings didn't collapse as much as they did, say, in 2009 with the great financial crisis when banks were broke, consumers were broke, corporations were broke. That bottomed at 10 times. So you get a bottoming that starts the bear market. And then the first 2 years is all multiple expansion. You get 15 times, in this case, has gone to, 21 and a half. It's 22 right now. But like James said, you then need earnings. Earnings are what drives the bull market for years 3, 4, 5. And we're seeing it. We're going to have earnings up 10%. And there's a good chance you can have them up 10% next year. And then maybe one more year after that. So you got to focus on earnings. All right. This is our recession watch. 9 different indicators that we look at. We've got a dial on the far right there that green is go-go and blue's kind of neutral and red is watch out. We're right on the border of blue-green, and we've got a couple of them that could turn here. Inflation, I think, would be one that could turn from blue-neutral to where you send it green because we think inflation is not an issue. And then the other piece that could potentially happen is housing is neutral right now. We know that housing prices are very high. Affordability is ridiculous. And what we need to have happen is the mortgage rates, if we could get them to a high 5 handle, a point lower than they are, and it's walk with me or just stick with me for just a second. Typically, the mortgage, 30-year mortgage is priced off a 10-year. The 10-year is 4.25 right now, and it's typically 170 basis points over that. You should see mortgage rates right now today at 6% versus the 6.7 that they're at. There's some market manipulation or things that aren't quite right. The administration is fully aware of that. But if we start to get a rate cycle cut coming up here, that housing piece could flip and you could get this whole policy to go into a greens. It's moving in the right direction, which would still be constructive for another, few years of a bull market. Again, bull markets typically last 5+ years. We haven't even hit the end of year 3 yet. Okay, why don't you hit our price targets and then we'll close out here.
Yeah, when we kind of set these in July, on the high end it was 6,600. On the low end, 1,000. That the main thing we're watching there, as Kim alluded to earlier, is the earnings, because obviously that feeds into that multiple, or multiple times the earnings. As that moves higher, as expectations are beaten, we could see that continuing to, as a result, the price target continuing to move higher.
Yeah, that's exactly. And if you had, again, I'd mentioned earlier that we think the market could be 6,900 by the middle of next year. That would be 22 times the forward 12 month. Okay. So again, we think that the earnings for next year are going to be $300, but by the time you get to June, you'll be looking out at a number that'll be more like $315. And then by the time you get to the end of 2026, you'd probably have $330. So you'd have 22 times $330, which would get you a nice, healthy return. All right. Any closing comments you want?
I want to say, we appreciate the partnership. And I think, if you have any questions regarding our outlook or views or broader commentary, of course, we welcome those. But thanks for the time today, Kim.
Yeah, James, I would reiterate, echo what you just said. Can't do this without the advisors and your partnership. And we're here to help you guys out in any way, shape, or form. So thanks a lot. Appreciate it.
All right. Thank you.